Welcome, everybody, to the podcast. Excited to have you on this beautiful summer Wednesday, a little hotter than we'd like out there. I'm so happy to welcome to the show Matt Lubbers with BAM Capital. And Matt, great to have you. How are you today?
I'm doing great, Yvette. Thanks for having me here.
Absolutely. Thanks for participating. And Matt, one of the big things that we like to do here on the podcast for NRI Wealth Architects is basically just bring education to the table. Now, a lot of my clients are, as you know, business owners, entrepreneurs, and we're talking a lot these days about self directed IRAs and the types of investments that are really tax savvy and help you not only to get tax credits and benefits, but also to really start increasing your passive wealth more aggressively, or wealth that you're not trading your time to earn. So BAM fits beautifully into that portfolio or into that concept. Can you introduce us to BAM and take us through some ideas of how this, fits in for tax savvy wealth?
Yeah, absolutely. And I'm happy to try and break it down in very simple form. But it's interesting you bring up self-directed IRAs because that's been every year a growing part of our business as well, as
Yeah,
that's become more accessible and more of our investors are using that vehicle to invest in real estate.
excellent.
Um, but taking a step back, so BAM Capital, the company was founded in 2010, so we're about 16 years in. We
Amazing.
are focused exclusively on multifamily properties. So that's the fancy way of saying apartment communities
Right.
or apartment complexes. Got to
Right.
always make it, a slightly fancier word than what you're actually trying to say.
And I
Uh,
appreciate that because they say syndicated real estate, and
yeah,
people are like, well, wait a second. I think I know what that means.
syndicated, self-directed IRA. Yeah, you keep going on with the big terms in the financial services world, in the real estate world. But yeah, we're an investment or syndicator group. So all that means is we find and acquire apartment communities that we see operational value add. Another big phrase there, operational value add. But what we mean by that is um, there is an opportunity for us to come in and bring our team in
Hmm.
to run these apartment communities more effectively.
Okay.
An interesting thing about apartments is that something I learned early on in this business is it's natural to think, hey, it's where people live in the same way that they live in houses. But houses, you know, single family homes or homes, that we live in, the value and the pricing of a house is very different than how the pricing works for an apartment community. Apartment
That's
community
interesting.
is
Yeah.
much more of a business approach, meaning that we're looking at what is the bottom line, the net operating income at the end of the year. So we can get
Sure.
into more of that, but that I think is just an important context to understand how a group like ours goes and finds an apartment community where we're looking at the bottom line and therefore the price to pay. And then we say, if we can grow that bottom line, just as you buy a business, you grow the bottom line, the valuation increases. So
Right.
it's the same story in real estate syndication or whatever you want to call it, investment real estate.
That's a really interesting comparison against individual home ownership, as you said, because we hear a lot of times from clients, I want to buy rental properties. And there's a ginormous headache that goes with that when you're buying an individual home or property. But when you have the ability to be part of a syndication, in other words, like you said, apartment complexes, and reap all the benefits without having to do all the work, that's an amazing concept that I think a lot of people need to know a lot more about. So,
Yeah,
yeah.
yeah, that's actually my personal story of getting involved in this business. I spent many years in small tech companies, very different than investing at real estate, but venture backed small tech companies. Again, very different way to value, different work. But I was that person that I was the person. Actually, my wife and I kind of joke. We were like, oh man, our friends are buying these small houses as an Airbnb. I was like, I want to do that. And then
Sure.
when it actually came to it, I was like, I
Wait
don't
a
actually
minute.
want to take care of it.
Wait a
I like the
second.
idea of it, but then I was like, oh wait, I'm gonna have to cut the grass, and I don't want to do that.
Yeah.
And nothing wrong with that. But to your point, like and we talk a lot about this with the people that are interested in our world, and how I
Mhm.
came to be interested in this world is there's really three primary ways to own real estate, whether it's a home, that you're renting out, or Airbnb, or an apartment community. You could buy a duplex or eightplex, right? Meaning like 8 units. But we talk about kind of the three ways, and so if we think about each of those, there's the owning and managing yourself.
Right.
There's owning yourself but using a third party management group.
Mhm.
And then there's working with a real estate syndicator like us, right, who's going to do the work on your behalf. And if
Great.
you'd like, I can kind of walk through kind of the general pros and cons that we see in each of those.
I would love that, Matt. And can I throw in a sidebar? Because oftentimes, there's so much lingo and jargon, and I think people understand a lot less than what they put on to understand. So certainly not insulting anyone at all, but could you just make a brief comment on how syndicated real estate ownership that you're talking about is different than owning a REIT?
Yes, thank you. So a REIT, or a real estate investment trust, is going to be a publicly available offering in the public market. And so, whereas we live, if you think just kind of in broad sense, public markets versus private. So we
Right.
live in private real estate, right? So we are in a different way, not responsible to SEC regulations, but we are, there's a lot of regulation in our world. But that's simply it: is public versus private. REITs are also generally much bigger and own generally speaking, many different types of asset classes. So when we say asset classes in real estate, think multifamily or apartments, industrial, so warehouses, retail or shopping centers, etc. Office is kind of the fourth big one. Those are the four main ones. And generally with a REIT, you're spreading your exposure across. Whereas, as
Mm-hmm.
I said, our focus is what we know is how to own and operate and add value to an apartment community. So it really is in the spirit of, as a private real estate syndicator, as opposed to a public REIT, it is a stay focused on what you're good at.
Exactly. I appreciate that explanation. I often tell them it's the difference between owning gold and you can hold it in your hand versus paper gold that you own on the stock market. You have a REIT. Okay. It's a certificate. It's a mutual fund, if you will. It's a real estate mutual fund, so to speak.
Yeah.
And it's basically not tangible ownership. You can drill it down and, check your properties in the REIT and all those things. But this is private ownership of a tangible building you can go and visit
Yeah.
and know that you have an ownership stake in. And then we're going to talk in a minute on the amazing tax benefits that come along with this. So I'm sorry, I just interjected that as a
No,
caveat
that's
and interrupted you. But by all means, tell us a little bit more about that.
I mean, that's exactly it, right? I think another thing that I found fascinating, and I don't know that I should have, because I was kind of had a similar mindset coming in, but it's like what you just said about driving by and being like, I own part of that apartment community.
Right.
Like we like that, and there's,
Yeah.
I mean, if you own a REIT, yes, you do. You own one sliver of it, but in the apartment community, you might actually own, we'll say, a door and a unit, whereas in a REIT, you might own one brick within the
Right.
retail center.
Piece of the
That
carpet.
yeah, sliver of the
Yeah, that you
carpet.
can't control or claim or have anything really to do with.
Yeah, and those
Yeah.
are generally the other terms that we hear in our space is core or core plus. Like REITs are going to be, because they're spread out, they're more diversified. You're going to have an expected kind of coupon or expected return, whereas private real estate, there is more upside because there's a specific business plan to improve, and that's when we use that phrase value add,
Right.
improve it, and then with desire to sell it. Generally, REITs are buy and hold, whereas we're buy, improve, and then sell. So another kind of core differentiation that we see between the two worlds.
That's a great model. So if I'm an investor, I'm new to this, and I come to NRI and, I'm shown BAM Capital. Tell me about that. What's in that for me? What does that look like?
Yeah, yeah. So there's we have two funds. I think that's an important starting spot. Is that we realize that there are people that want to make income off of real estate, so
Right.
replacing income, getting a monthly check or coupon. So every month you can get a check to your checking account or to your bank account, and then let's say I always say kind of on the other side of the spectrum. I don't maybe need the money right now. I want it to grow in real estate, but I'm okay with it being illiquid for what we're in our world. We're aiming to get the fund started, filled up, and then sold off in a 5 to 7 year time period.
Got it.
So then you ask like, what's in it for you? The income side is more of the, I'll say, safe, stable. And what we do is on that we pay an 8% current. So every
Nice.
month you're getting paid. 8% is annualized, but you get a check every month. The total target on that is 10 to 12%. So
Wow.
another way to think about that is you're going to get your 8%, and we're taking think like rent, right? Rent checks come in every month, and so we pay our team, we pay the debt service that needs to run the property, and we pay for maintenance, and then we take a sliver, and that pays that 8% current. Um, and then there's that additional 2 to 4% that accrues in your account. So people that are fit for that, they're looking for that income, is generally, again, looking to replace the income. It's
Right.
I'm in retirement or approaching retirement, and I want to make sure I'm getting income another way. That most commonly is, I think, the best way that I feel like resonates with people is like a bond alternative.
Right.
Bonds are going to pay 4.5, 5%. This is going to pay you 8, more likely closer to 10 and up to 12, as that continues, as that fund in your investment continues to accrue and grow over the years. So
Right.
more liquid monthly payments, safer 8, 10, 12%. And then on the other end, the illiquid 5 to 7 year fund. So I'll talk about the numbers.
Sure.
I'll talk about them now.
Oh,
Our expected target returns in that world is 15 to 20%.
that's
We have
amazing.
taken that's an IRR percentage. So
Right.
15 to 20% IRR over that 5 to 7 year period means somewhere in the range of 2 to 2.5x your invested capital. That's the multiple too. So think of doubling to 2.5xing your money in the 5 to 7 year period.
Wow.
With that fund, just so people can wrap their head around that, and kind of in that spirit of drive by and be like, I own part of that. We will wrap probably 8, or in the current fund we're in our fifth fund. So that means
Mm.
1, 2, 3, and 4 are running. We've bought all those properties. We've sold off some of them and returned people's money with the growth.
Okay.
But in Fund 5 right now, we're just under contract for our fourth property, and it'll probably end up being 8 or 9 total. So you're basically part
That's
owner of
great.
8 or 9 apartment communities, and we want to double the value of each of those,
Okay.
double the equity value. Not the we're not buying it for 50 million and selling it for 100 million, but we're buying it for 50 million with part equity and
Right.
part debt. We pay the debt and we double the equity in order to help people get great returns.
That's amazing. And that type of return that you're talking about is beating out just about everything else that we can compare it to. You mentioned bonds, and that doesn't even, scratch the surface when we're talking about these kinds of returns. And Matt, what's really interesting is I'm a numbers person. Obviously, I do the financial side, but if we look at it, say I'm going to go out and buy a house and I'm going to rent it out, we're talking about sometimes very, very small profit margins. If there's a mortgage, if we didn't buy it cash, if we did buy it cash, we have to include, the loss of our initial investment, so to speak, the time to recuperate that, where the monthly income could be very slim when we've done, all the math, so to speak.
Yeah.
I know clients who are making like $50 on some of their rentals a month. Others are negative, and they're just using it as some sort of, tax play, which a lot of times isn't very effective. So when we look at this, it seems kind of like a slam dunk, as far as, hey, this is being managed by someone. I'm part owner. We're going to talk about the tax benefits in a moment. And it's actually a positive cash flow instead of buying an individual property and hoping for the best. I mean, am I right? Am I thinking correctly?
Yeah, I mean that's definitely the story, right? I think you're going to hear stories on the other end of what you're describing, where somebody bought a house for 500,000, and then they, let's say they put 100,000 down. So let's just play through a
Right.
math scenario. I'll play devil's advocate on you. Put
Right.
$100,000 down. They rented it out, so they basically broke even. And then the market went up, and they sold it for 700,000, and their 100,000 turned into 300,000
There you
in
go.
3 years. So
Yeah.
there are stories of that, right? Like,
Oh, there is.
yeah,
There,
yeah. So
yes,
it
many.
is definitely not a one size fits all. I think why we do our funds, instead of just doing single assets. Like, you're an owner of that apartment, you're an owner of these eight, is because there's probably in any fund going to be a couple. We'll use baseball, a couple singles, a couple doubles, a triple, and a couple home runs. But we
Right.
know that that's going to round out to be in that 15 to 20% IRR range.
Correct.
Um, the other thing, that you hit on, just as, if you, like, that the audience here, you're thinking about, do I want to own a single family home or be part of a syndicator? Let's just quickly talk about the pros and cons. So you
Sure.
own and manage,
Yeah.
you might have that upside that I just talked about. So
Right.
maximum profit potential, and you have maximum control. I think that's an important, in the spirit of devil's advocate too, right? Complete control. You get to decide, do I want to paint? Do I want to put a new roof on? How do I want to do the landscaping? Whereas
That's
with
true.
us, we're
Yeah,
we're in control of that. You're putting trust in us to go make the best decisions on behalf of you as our investor.
exactly.
But the con, which you kind of alluded to, is it becomes a part-time job. Do you want that? You want to be on call 24/7? We talk about, you gotta have to, at the end of the day, deal with tenants, toilets, and trash. So do you want to deal with the three T's,
Yeah,
or do you want to basically hire somebody else to do that?
exactly.
The middle portion, I think people may be thinking about, is like, I can buy a home and then I can use a third party management. And in that case, you do get still the control, right? The roofs, the
Right.
painting, the landscaping. It's not a 24/7 job anymore, because the property management company is going to take a lot of that on. But you're going to pay a pretty penny. Usually they're
Yes.
charging around 10%, is what I've heard is kind of industry norm. So
Oh, yeah.
rent check comes in for 2,000, they take 200 and pass on 1,800. So it really does cut into the margin.
Oh,
Um,
in California, you can pretty much double that. Yeah, out here, it's I've heard as high as 25%.
well, I didn't expect to say this, but that's why you moved to Indiana. That's always an option for
Right, where things are still civilized.
you. This
I
is
know.
we're gonna get this off the rails. That's a whole nother
Oh,
podcast.
let's not go there. California is not civilized, my friend.
Uh,
Yeah, we're talking to Matt about, I think, the passive client who, in other words, when we're talking about building passive wealth,
yeah,
that's really where BAM, to me, shines, because these are not folks who are willing to trade their time for these efforts anymore, And if you want to get in the real estate game and you want it to be passive income, you need to look at something like this, because otherwise you're pretty much doing it yourself, and or, like you said, giving so much of your profits to property management, which is fine. You can have, we're not certainly downing individual ownership. It's great. But if you're looking for that passive income, this is a great avenue.
yeah, yeah. And I think that's a good call out, right? Of obviously your audience and the followers of NRI and those that work with NRI. Like, those are typically people that want to put their time into their business, that they
Right.
run, their families, and probably not tenants,
Yeah.
toilets, and trash.
Toilets and it's always plumbing and air conditioning out here. We find plumbing and air conditioning, and they're both grossly expensive. I need more plumbers as clients because they're making bank
They're
out
making
here.
bank.
And one of the most exciting things about this, man, and I can't believe I'm going to say this, but the most exciting thing to me about this offering is the tax benefit. I mean, it's crazy what you're about to tell me, but can you enlighten our listeners about the
Yeah.
amazing flow through tax benefits?
Yes. So, with the fund, there is depreciation that we can take on and we pass 100% of that depreciation onto the investors. That's what creates the tax benefits that Yvette's talking about.
Wow.
So this year, the year 2026, we are on target to get about what we're saying 75 to 80% of the investment that you make in accelerated depreciation that we're going to pass along to you.
Wow.
So why I say we pass along 100%, but it's going to be 75 or 80. That just what I'm trying to describe is we buy a new. Let me explain it in simple terms. We buy a new property, buy a new apartment, and we do what's called a cost segregation analysis, which is say somebody professional comes in and looks at and says, this is how much depreciation you can take on a property for the siding and the roofs and the ovens and everything, right? That is going to depreciate over time within the apartment community.
Right.
We take that and we pass it along. So all of that added up, we anticipate will be, like I just said, kind of in that 75 to 80% range. So if you make use simple numbers here, you make $1 million investment into the fund, then you should expect a negative K1 of 750 to 800K. That is that 75 to 80% because we'll package all that up. One thing that's important is that is where it can be utilized. It can be carried forward indefinitely. So a lot of people like, I know I'll use this later in life, but if you need it near term, it is for passive income that's earned. So it's passive to passive that is offset. And I think a lot of people know that, but generally what we find ourselves in conversations around this is that's very attractive. I need to talk to my CPA to see, can I utilize that? Right. How can I utilize it? Right. We want to be knowledgeable, of course, and we can guide you on how people are using it. Yes. But it is important to bring in a CPA. In fact, we often, this is just a quick aside, but we often laugh around our office. It's usually like December 28th or 29th when people call and they're like, I need to get my money into something passive. And, you know, our joke here is like, you could have called us in October, November. Like you didn't all of a sudden just make all your money, but
I promise my clients won't do that to you.
We don't
but
mind.
No,
we don't mind.
It's true. And yeah, 100%. We're working with Tom Wheelwright, Wealth Ability as our tax division, and it's incredible. You have to, just as you said, you have to architect this stuff, Matt. It's got to be planned for in advance. Otherwise, you know, bottom of the ninth isn't going to cut it. But that's a huge. So they do the cost segregation that passes on to, let's say, our client as the part owner, and anything else going along with that?
No, I mean, that's the crux of it, right? Is again, you're going to receive from us for your investment. You're going to receive the K1 that's going to show all of the losses. Oh, and a point I was just going to make to kind of clarify this: through the One Big Beautiful Bill, we've heard that was passed in 2025. We, know that there are many pieces of that, and I'd say, political alignment aside, factually, that had pieces within it where that allowed us to move to depreciate 100% of that upfront. So this is not something that's always been available. It became a big benefit to our investors in 2025 when they extended the law to say 100% of the depreciation can be used in year one.
That's huge. Exactly. That's what I was hinting at, was the changes in that, the beautiful bill. And, there's a lot of talk on that. Well, when Trump gets out of office, everything's going to change. Well, not necessarily. These are congressional moves, but very interesting, very lucrative. What would you say, Matt, to someone coming in as a first-time client, maybe not a repeat client yet, and as to cons? Well, do you feel that there's any downside to investing in the passive syndicated real estate?
Yeah. I think the first thing I like to always address up front is like the illiquidity nature of these investments. And so just knowing, like, I'm always the first to say, we do have our income fund, right? That might make sense if that's what you're interested in. But if it's not, if it's like, I have some money on the sidelines and I'm interested in owning real estate, but I'd like somebody else to do it. It's like the two things that are related are the control and the illiquidity. And so what I mean by those two words, I touched on illiquidity, but that is to say, we're the first to say, okay, like, we you're going to buy these 8 or 9 apartment communities on your behalf. We're going to get to work on putting our business plan in place and improving them. And history has shown through our track record and through all the deals that we've gone full cycle on that it's going to take 3 or 4 years before that business plan really starts to rear its head in terms of getting our net revenue or net operating income to a place where we can then take it to market and put a for sale sign, so to speak, in the front yard. But all that to say, like, you're going to put this money in and don't expect a check for at least 4, maybe 5 years.
Okay.
And so, yeah, like, again, just like,
Right.
it's very important to have the right expectations going in. And then when I use the word control, it's kind of what we talked about with the pros and cons of buying your own place. You are trusting us as you become a limited partner in our deals, to make the best decisions on your behalf. But the control is related also to, like, how much thought, work, effort, time do you want to put into a place that you may buy yourself?
Yeah. No, that's great. Thank you. And because obviously, I've looked at your portfolios, BAM is doing it right. What would you say might be some red flags, things to look for in competitors or out there in the marketplace that you see are, doing it wrong? In other words, what are those markers to look for an investor?
Yeah, I don't think, I'll be the first to say there's a lot of people doing it right. And I think you should do your research. And there's a lot of groups like ours. So I guess to first address kind of like any red flags, it would be more of like, get to know the people that are running it. And then look at the track record, right? I think it's pretty obvious, but you can usually see what's happened in the past in the same way people behave similarly in the past as they're going to in the future.
Right.
Companies are going to behave in the past and in the future. We talk a lot of it in our world about, we use the analogy of, think of horse racing. You're betting on both the horse and the jockey. So in our world, the horse is the asset class, right? That is like, am I betting on, the fact that apartments are going to continue, people are going to continue to prioritize roofs and beds? Or do I want to take a bet on industrial because e-commerce, and I'm just seeing what percent of things are being bought by Amazon and online. So there's a lot of tailwinds with industrial real estate right now, which is great.
Which is
or
great. Yeah.
do I want to bet on the horse that is retail or commercial or office, because companies are making people come back to the office.
Yeah.
So what was down is coming back.
Right.
More people are going to the malls, right? So I'm giving you an example of, like, those are the horses you can bet on. But then when you decide, like, I like that horse, right? I like industrial, or I like apartments. Then it's when we talk about the jockey, those are the people, right? Those are the people that are running the business. So that's the operator. That's, again, where you're going to look at track record. I would always encourage asking about, your due diligence material. I think that just shows a maturity, right? Like, if they don't have a due diligence room that they can open up and show you their books, their track record, their funds, their operating agreements all in one place, I think it'd be, maybe heavy to say, or too much to say necessarily a red flag. But I think those are things that you can do in the due diligence process, again, as you choose both the horse and the jockey. Is that
100%. I love that analogy. That's 100% acceptable and correct, because due diligence is everything. And if the company that you're getting involved with, we always tell our clients, we have vetted you. This investment has been vetted by us if we're recommending it, because they have opened everything up and shown it to us. But by all means, you go behind us and do the same thing. If it's hidden, if it's based on faith, avoid it. The Bernie Madoffs of the world are plentiful, and we want to make sure that we stay far and wide from all of that. So
another thing we hear often is around, my cousin's buying this apartment, and again, like, I hope it works out, but I would just be my friend, right? I would just encourage you to be cognizant of, if you're comfortable potentially losing the money, that's one thing. But think about how, we've heard too many times of, like, how it severs a relationship or something that, it's probably worthwhile saying no up front if that's going to both affect your financial life and your relationship with that person. Again, a lot of people are I'm not saying it's not well intended and there's a business plan that they've laid out, but it is true that a lot of times it's not going to work out. So just think through what that's going to mean if it doesn't. I know it's easy to look at, the business plan and say it's going to, but if it doesn't, how's that going to affect your financial life and your relationship with that person that might be close to you?
100%. Thank you for that, Matt. And for all of this, I can't believe our time is going by so quickly. But just in a recap, BAM Capital, 15 years out there and fully transparent, syndicated real estate, working with SDIRAs and the tax credits that go along with passive real estate ownership. So 100% we're looking forward to seeing you at our summit. So for everyone listening, BAM will be one of the speaking components of the summit. We'll be excited to hear more, the industry insights, what you have available. And you can check that out, grab your ticket at www.sonicboomsummit.com. Happening here in Temecula. There it is. There's a flyer. Thanks, Matt. They're coming out from their Midwest part of the country, avoiding all kinds of tornadoes to come see us in California, September 28th, 29th, and 30th. So, Matt, thank you so much for joining us on the show today.
It's fun to be with you. Look forward to meeting a lot of you out there in September. So thanks, Yvette.
I'm excited. We'll see you then, my friend. And
All
for
right,
everyone listening, have a great day. Thanks for tuning in. We'll see you on the next show.